Scene script. Ever wondered why understanding taxable pension matters to you? Well, it's all about planning for your financial future. You see, when you enter the golden phase of retirement, your regular income ceases and a pension becomes your primary source of income. And just like your income from employment, your pension is subject to taxation. However, the rules of taxation are somewhat different, and understanding these rules is crucial for effective financial planning. Let's delve a bit deeper into this. Your pension is essentially a reward for your years of hard work, a financial safety net that helps you maintain your standard of living even after you've hung up your work boots. But here's the catch: your pension is not entirely tax-free. A portion of it, known as the taxable pension, is subject to income tax under the Income Tax Act of 1961. This means that the amount of pension you receive in hand, your take-home pension, is actually less than your gross pension. Now you may wonder, why does this matter? The answer is simple. Understanding the concept of taxable pension allows you to accurately calculate your take-home pension. This, in turn, helps you plan your post-retirement expenses, ensuring you live comfortably without straining your finances. Moreover, your taxable pension also affects your overall tax liability. By understanding how much of your pension is taxable, you can effectively manage your tax payments and perhaps even find ways to minimize your tax liability. In essence, understanding taxable pension is not merely about knowing how much tax you need to pay. It's about being in control of your financial future, about being able to make informed decisions that ensure your retirement years are as comfortable and stress-free as possible. With a solid understanding of taxable pension, you can better plan for your financial future. Taxable pension, a term you've heard, but what does it really mean? Let's demystify this today. In the simplest terms, taxable pension is the portion of your pension income that is subject to tax under the Income Tax Act of 1961. It's important to note that your pension, whether it's from a government job, a private company, or even a foreign source, forms part of your total income and thus is subject to tax. Now, let's delve deeper into the two types of pensions that exist: uncommuted and commuted. Uncommuted pension is what you might think of as a traditional pension. It's a periodic payment, often monthly, that you receive after retirement. This regular income is fully taxable for everyone, no matter if you're a government or a non-government employee. On the other hand, we have the commuted pension. This is a lump sum payment that you receive instead of periodic payments. Think of it as getting a portion or even all of your future pension payments in one go. Now, this is where the tax rules get a little intricate. If you are a government employee, congratulations, your commuted pension is entirely tax-free. However, if you're a non-government employee, the tax exemption will depend on whether you receive gratuity along with your pension. If you do, 1/3 of the pension that you would have received is tax-free. If you don't receive gratuity, the tax-free portion goes up to 1/2. It's important to understand these distinctions as they can significantly impact your tax liability. And remember, while the process of understanding and calculating your taxable pension might seem daunting at first, it's a vital part of planning for your financial future. Knowing the difference between uncommuted and commuted pension is the first step towards understanding your taxable pension. So keep this knowledge in your back pocket. It will surely come in handy when you're navigating the twisty turns of pension taxation. Now that we have the basics down, how about we dive into the calculation of taxable pension? To start, it's essential to know that the Income Tax Act of 1961 categorizes pensions into two types: commuted and uncommuted. Commuted pension refers to receiving a lump sum amount in advance, while uncommuted pension refers to a periodical or regular pension received, usually monthly. Let's start with the uncommuted pension. It's pretty straightforward. The entire amount received as an uncommuted pension is taxable under the head Income from Salaries. For example, if Mr. Sharma receives a monthly pension of 10,000 rupees, this amounts to an annual pension of 1,20,000 rupees. This entire amount is taxable. Now, onto the commuted pension. The taxability here depends on whether you receive gratuity along with your pension. If you're receiving gratuity, 1/3 of the full value of your pension is tax-free. The remaining 2/3 is taxable. However, if you are not receiving gratuity, half of the full value of your pension is tax-free and the other half is taxable. Let's illustrate this with an example. Say Miss Gupta receives a commuted pension of 3 lakh rupees and she also receives gratuity. In this case, 1 lakh rupees is tax-free and the remaining 2 lakh is taxable. If Miss Gupta did not receive gratuity, 1.5 lakh rupees would be tax-free and the other 1.5 lakh would be taxable. Remember, while calculating your taxable pension, you should also consider the standard deduction applicable for pensioners under the Income Tax Act. For the financial year 2024-2025, this standard deduction is 50,000 rupees. Calculating taxable pension might seem daunting at first, but with these steps, it becomes a walk in the park. As long as you understand the difference between commuted and uncommuted pensions and remember to apply your standard deduction, you'll be able to navigate your way through. As we navigate the world of taxable pensions, it's essential to sidestep common pitfalls. Let's shed some light on these often traveled roads of error and misconception. First and foremost, many believe that all pension amounts are fully taxable. This is not entirely true. Under the Income Tax Act of 1961, only the portion of the pension that exceeds the basic exemption limit is taxable. So, don't rush to pay taxes on the entire pension amount. Next up, the prevalent mistake is the misunderstanding of commuted and uncommuted pensions. A commuted pension is a lump sum received in advance, while an uncommuted pension is a regular monthly amount. Many fail to realize that for government employees, commuted pensions are entirely tax-free, while for non-government employees, 1/3 of the pension is tax-free if they receive gratuity and half if they do not. Thirdly, there's a common notion that pension received from abroad is not taxable in India. However, the tax laws state otherwise. If you are a resident of India, your global income is taxable, which includes your pension from abroad. Then, there's the misconception about the taxation of family pensions. Many assume that family pensions are fully exempt from tax. However, a standard deduction of 33 and 1/3% or 15,000 rupees, whichever is less, is allowed on family pension. Lastly, many people overlook the importance of filing their tax returns, assuming that since tax has been deducted at source, there's no need to file. This is a grave mistake, as filing tax returns is mandatory for everyone whose income exceeds the basic exemption limit. Let's not forget that the tax laws are subject to change, and it's imperative to stay updated to avoid falling into these traps. Being aware of these common mistakes and misconceptions can save you from unnecessary headaches down the line. Scene script. Let's round this up, shall we? What are the key takeaways from our discussion on taxable pension? The first thing we've learned today is that taxable pension is not as daunting as it might sound. It's simply the portion of your pension income that falls under the Income Tax Act of 1961 and thus is subject to taxation. We've also delved into the two types of pensions, commuted and uncommuted. Remember, a commuted pension is a lump sum payment you receive upon retirement, while an uncommuted pension is a periodic payment made throughout your retirement. The tax treatment varies between these two types, with commuted pension being partially or wholly exempt from tax based on specific conditions and uncommuted pension being fully taxable. Now, when it comes to calculating your taxable pension, don't forget that it's about more than just crunching numbers. It involves understanding your pension scheme, whether it's from a government or non-government source, and how that impacts your tax liabilities. We also highlighted the common mistakes and misconceptions that often trip people up. For instance, the idea that all pensions are tax-free, or that the tax rates for pension income are different from other income types. These misconceptions can lead to miscalculations and potential financial missteps. Remember, understanding your pension and its tax implications is crucial for effective financial planning. It helps you to accurately predict your post-retirement income and plan for any potential tax liabilities. It's about being proactive, not reactive, and making sure you're prepared for the future. So, that's a wrap on our discussion about taxable pension. We hope this has shed light on the subject and given you a solid foundation to build upon. Remember, Understanding your taxable pension is not just about numbers, it's about making informed decisions for your financial future.